Be sure to watch my TED Talk on londonreal.tv. In London, technology is the Silicon Roundabout. Introducing a new talk show dedicated to the people of the London technology startup scene. Silicon Real. Each week, interviewing entrepreneurs, venture capitalists, financial technology, accelerators, and incubators in an exciting three-person format. Learn about the people behind the innovation. Locally filmed, locally sourced. Silicon Real. It's about the people. This is Silicon Real, the weekly talk show dedicated to those folks of the London technology startup scene. I'm Brian Rose. I also host London Real. It's the same studio. We've had Mr. Tim Ferriss, who we've just been talking about a year ago, who says, don't pick up your phone. And we've had British MP George Galloway on here, Neil deGrasse Tyson, a bunch of others. So check that out at londonreal.tv. But today we're here to talk tech. My right-hand man, Mr. Colin Pyle, entrepreneur, coffee guy. What's going on with you? We're losing you for a couple weeks, right?
Yeah, I'm going to the bad United States of America.
Careful with those Yanks, man, especially those tech guys. Don't trust them.
You sound American, though.
Yeah.
Ooh, wow. Be careful, those Americans. They're going to try to give you money now. They're going to be like, here, take 20 million. Just take it.
So yeah, New York, San Fran, and I'm visiting your Bulletproof boys in LA, which would be really cool. Otherwise, yeah, the India ride came out on Travel Channel this past week, so not in the UK though, everywhere else.
Okay, so we can't watch it live now.
Yeah, Travel Channel UK is going to play it in September, so.
Okay.
So yeah, we'll see. Got some interesting tweets. People are enjoying it.
Are they liking it? Yeah.
Yeah, it's hard to tell. You get like 15 people who like it, maybe.
I saw you in the rat temple. I saw the rats everywhere, and I was like, Jesus. It looks more colorful than the China ride.
There's a lot more engagement,
a lot more going on.
Yeah, just language and barriers. We were shooting legally, whereas China was illegally. So
right. Okay.
That always helps.
If they want to learn more about you, they can actually buy your China ride, the Middle Kingdom ride on Amazon. It's Colin riding all around China for 60-some days, Guinness Book World Record. You know, this is what he does in his spare time.
And it'll be on Netflix, hopefully August, September. So
fantastic.
That may be easier.
Awesome. Okay, cool. Say hi to the Bulletproof executive, Dave Asprey, when you're out in LA for me.
I can't wait.
We love those guys. On to the show. Our guest today is Mr. Christian Faes, who is the founder of LendInvest, a P2P lending platform focused on the property industry in the UK. I think it's specifically London.
Yep.
I believe you guys require a £10,000 minimum investment.
We do, yeah.
And you guys offer at sometimes up to 12% annual returns on short-term mortgage finance. It's more like bridge loans.
It is.
I think you've completed about £67 million in loans, according to your up-to-the-date website, secured against about £120 million of real estate. You were previously a city lawyer with Clifford Chance and Deutsche Bank. Christian, welcome to Silicon Real.
Thank you very much. Yeah.
How's my intro? I'm getting
you're spot on. Yeah,
I'm getting to be pretty well known for my intros. I think it's the passion that I deliver.
It really is. And the conciseness.
Is it really? I try to break it down. You know, I work on it. You know, before we jump into the specifics of LendInvest, you know, fintech is London's pride and joy, right? We've been talking about this for the last year. We've had kind of the who's who of fintech on here. We've had TransferWise, Market Invoice, Open Gamma, Cedars, DoDill. We invited Wonga, but you know, I think they're just too scared to come on. You know,
invited them.
I respect that. I did invite Wonga, but you know,
open platform here.
Yeah, I mean, this is before their latest kind of bad press, but who knows? Maybe they'll come on. But I wanted to know just a bit about you before we jump into the company. You know, you were in the city. Now you're in a fintech play.
Yeah.
Do you miss the old times in the city? When you left in 08, were you really thinking fintech, or there wasn't really the tech yet to go with the fin?
No.
Tell us about your background real quick.
Yeah, definitely. So, I mean, yeah, city lawyer, did all that sort of stuff. In-house with an investment bank as well, so I sort of saw the finance side of things. So that was good. I guess we're a little bit different in the sense that we're a tech startup, but actually we're a lending business first. Right. So, you know, we set up in late 2008 a mortgage lending business, and that's what we were. And sort of it's later that we came onto the tech side of things.
Right. So it was finance company first, tech later.
Yeah.
Okay. And do you miss those days of the city? I always bump into my old city colleagues. They're always grumbling. No one grumbles about a pay cut like a banker in the city. I don't know if you ever found this. It's never like it used to be. I don't know. Do you miss those guys at all?
No.
Okay.
Did you expect me to say yes? No.
I don't know.
I mean, yeah. I mean, I think what we're doing is a good intersection between the two industries. But yeah, definitely. London is the center of fintech. We think globally, and I think it makes sense for that. And most people that are operating in that space are pretty excited about it. And it's an exciting place to be in that sort of business at the moment.
Talk to us about your company. It was interesting. You talk about some of the rates of the return, and they get people jumping out of their chairs. And then, it looks like you provide financing when people can't get it. And I don't want to ask you this in the wrong way, but are you the Wonga of mortgage finance in a weird way? Because you're providing loans in like 2 weeks' notice sometimes to get these projects done. I mean, that's real value added, right? But then on the other side, people are saying the rates are too high. So.
Well, I mean, it is expensive finance, but it's short-term finance. So, we lend to a borrower at 12%, which is a high interest rate. If it's a 24-year mortgage, sure, that's going to be an expensive rate of interest, and no one would take that sort of mortgage. But the average duration for us is like 6 months. And the thing is, to get a mortgage in the UK is very difficult. For property developers and property entrepreneurs who are our sort of core, target group, it can take them 6 months to get a mortgage. Where the market's moving too quick for that. So they've either got to have cash or, have investors that back them. And we sort of see ourselves as almost being investors that back them, but we provide quick capital. So using technology to try and get efficiencies in terms of what we're doing, and we can provide funding in a couple of weeks. So it's expensive, but a lot of these guys are faced with the prospect of either not doing the deal, they miss the opportunity, or taking slightly expensive funding.
When I hear rates like 12%, even on short term, there must be a bubble there, or a big growing economy, because we know the property market in London is up, what, 20% year on year?
London market's strong.
It's very strong, which means that there's a lot of things happening, and they need to happen fast, which makes you very valuable, and means guys will pay 12% because there's a lot of moving parts, and they can make
and there's always a commercial need for the funding. So we're definitely not placed as a lender of last resort. So we're not funders that provide funding where the borrower can't get funding. It's really where they just can't get it quick enough. So typically the bank will take us out at the end. So we'll provide the quick funding, they can secure the project, and then the bank will take us out. So they're bank quality loans. It's just the banks are too slow.
How's business?
It's good. Yeah, it's very good. I mean, I think the London market's very strong in terms of the residential property market, but I think countrywide there's a real it's just simple supply-demand economics. There's not enough new housing in the UK, and we've got a rising population. So I think it's going to be strong for a long time to come.
Do you ever work with small guys like you or I just buying a £500,000 house or whatever, and they actually want to maybe do a longer term mortgage, or is that completely not your game?
It's not at the moment, so it's very focused on the short term stuff. But in terms of the profile of borrower, sure. I mean, we phrase them as property entrepreneurs, so it's guys that are sort of doing this full time. They're not sort of amateurs, but I mean, a lot of our borrowers are individuals that are sort of. That's what they do. They buy flats, they renovate them, and they sell them on. And they make a very good living doing that, even with relatively expensive funding.
Right.
Are property markets going up or going down? Take us forward 1 year. Are we up 10%? Are we down 10%?
I don't know if we'll be up 10%, but I'm pretty certain we won't be down 10%. Okay. I mean, I think the London market's cooled off the last little while, and we've got the election coming up, so people will understandably be a little bit nervous about that. You've got the Labour Party with their sort of mansion taxes and all these sorts of policies that are being proposed. So
is that going to happen, the mansion tax?
I mean, I think if the Labour Party get in, they're going to try for it, definitely.
What's the mansion tax?
What is it? Is it kind of like a luxury tax? Is it an annual tax?
Yeah, it's an annual tax. So if you own a flat or a house worth more than £2 million, then you'll pay an annual fee, and it could be like 40 grand a year. So it's like prohibitive.
So like 2% or 1%. It's very prohibitive.
Wow.
Right? Yeah. That's not based on any income or rental income.
Yeah, exactly.
Or anything. I think that exists in California. Someone was telling me recently. Of all crazy places, you wouldn't expect something like that.
Because there is a tax for like foreigners who buy sort of luxury properties, is there not?
If you buy it in a foreign company.
Okay.
Yeah, it's really expensive. It's like 15% stamp duty.
Is it?
If you buy a property at over a certain bracket, I think it's like £2 million. So they're already putting in those sorts of things, which is having a cooling effect, and that's good. I mean, if the market sort of cools off, then it's more sustainable long term. As opposed to it can't go up 10% every year. That's fine. We prefer it to go up incrementally at a sensible pace, that's better for long term.
I think you're right about the property market. I mean, it's amazing to watch it go up, 15, 16, 20% in the last 6 months or 9 months, and in London is crazy, and the supply is so limited, and then lack of good supply is a whole nother question. Yeah. So in any bull market, you get all the jokers coming out too, and some of the stuff you see a picture of, and you're like, what? I mean, it's literally like, this is my cardboard box on the corner of this, and I need $500,000, but I don't see it coming way off. Even like a 5% dip or 8% dip, there's buyers out there. Who are we kidding? And now people have been conditioned that things are worth $1,200 a square foot, even where you live, probably $1,300, $1,400 a square foot in Notting Hill. And I remember I almost bought a property in Notting Hill around 07, right when the crash was about to happen. And then afterwards, I was like, oh,
you regretted it.
No, I was happy for a couple of years, and now the prices have blasted through there. So you mentioned a company in one of your talks called Lending Club in the U.S. And it's a huge peer-to-peer lender. It's got serious board members like John Mack, formerly of Morgan Stanley, Credit Suisse. It's got some, people.
Google's a major investor.
Yeah, I didn't even know about this. I mean, this must make you bullish on the market over here. What is going on with the U.S. when it comes to peer-to-peer lending?
So in the U.S., it's a bit more of a restrictive market. So there's a couple of main players. Lending Club and Prosper are the sort of two dominant players in sort of peer-to-peer lending. And it's massive in terms of the volumes they're achieving. It's surreal. I mean, Lending Club's lending sort of $300 to $400 million a month.
Is that secured lending, or
no? And that's unsecured lending.
I lend to my friend, or I lend to a business.
Well, you can lend to a business. It's typically sort of people buying a second-hand car, or they're consolidating their credit cards, or just traditional unsecured consumer finance. So,
what's the cost of that?
That's relatively expensive, but I mean, it's probably similar to what's better than credit card rates.
Right.
But it's good. It's a really good model, and it's really showing the potential for peer-to-peer. And I was at a conference recently, and it was a good explanation of sort of the Lending Club sort of model. And I guess what we're trying to do with peer-to-peer is, everyone in the room would have a credit card, but not everyone, and everyone probably pays a fairly similar rate. But actually, everyone in the room is probably quite a different sort of credit quality borrower. But with peer-to-peer, you can assess the actual individual borrower better, and you can determine rates, and the peers can sort of, it's democratizing finance, really. Yeah.
As a foreigner, I hate it coming over here. My credit can't transfer over, and it's so annoying. Like, I can't get a mortgage. If I tried.
It's a big issue. And that's a big market for us, actually. Foreign nationals that they can still put in 40% equity in a purchase, but they can't get a mortgage. I mean, I've got a friend who's a banker in the city, and he's just bought a house in Chiswick, trying to get a mortgage. He's been employed with this bank, top-tier bank, great credit rating, but he hasn't had a credit card for the last 2 years here, so he can't get a mortgage. It's like, it's just, there's no real sense to the mortgage process.
And these are some of your clients. Are they expats?
They're expats. Okay. So they'll come to us. We can bridge them while they can sort of sort out their affairs, get a credit card for a while, and start borrowing some debt so they get a credit rating and get on the system here. But again, there's no real sense to that.
Right.
So with peer-to-peer, we're trying to sort of, let the peers determine what is sensible. Because, for me, on paper, he's a good borrower.
Right.
But, but the bank doesn't think so. So it's a real sort of tick box mentality with bank lending.
With fintech, we always run around and talk about fintech, but it's almost like credit tech, because the success stories like Wonga, Market Invoice, we had Damien from DueDil on last week. I mean, the intel they have is because they're running these great credit checks, these real-time credit checks, and I know Wonga's really good at that. I'm guessing you guys are good at that.
Definitely. Okay.
So that is the tech.
Is it
credit tech?
It is credit tech.
Am I the first one to use that term?
Yeah, it's good. I like
Heard it here first.
.com. Someone's probably got it by now.
It's live. It's live. You had to say it live.
Just have a week.
Yeah, I mean, I think the idea is not, like we were saying, not to be a lender of last resort, but to actually be a better lender than the banks. To use technology that they don't use. So, so with our mortgage lending business, we've got a bank funding line, and part of that, they came in and did a full audit of what we do. And actually, one of their senior credit guys said, "You actually do more than what we do for borrowers." So, we take that stuff really seriously, and actually, it's trying to be at the cutting edge of better credit underwriting, as opposed to just sort of providing easier credit.
And what do you guys do?
Yeah, what do you do?
So, I mean, some of the things we do, we will we'll get all borrowers to take a smartphone photo of their passport, and then we can run it through this system that will analyze the font sizes, the watermarking, just a full digital analysis of the passport. Now, no bank is doing that when you go for a mortgage. We'll get the borrower's mobile phone number and we'll ping it. So mortgage fraud's a big issue, and you know, if they're a borrower, they say they're in London, they're buying a flat in Notting Hill, but it pings back they're in, you know, Afghanistan or whatever. You know, we'll start to ask questions in terms of where they are and you know, can they come into the office and that sort of stuff. You know, just sort of overlaying all these sort of technologies that are available and sort of making that as part of our sort of credit process.
So yeah, so those are great examples of kind of like eliminating fraud. But how do you determine, for example, if this guy you're going to lend, I'm assuming you turn some people down?
Yeah, definitely. Yeah.
So how does, you know, is it a loan to value thing? Is it, you know, looking at their credit history with guys like Doodle maybe?
Yeah, I mean, it's a bit of both. So for us, it's relatively short term, so we'll lend out to 3 years in duration. So the credit assessment is one of the borrower, which is primarily around fraud. As long as they say they are who they say they are, then you know, we're relatively happy to lend to them. You know, they're not a terrorist or, you know, the usual sort of stuff. And then it's an assessment of the asset. So have we got that valuation right? Are they really putting in 40% cash or whatever it may be? And, you know, just making sure. So it's not just as simple as sending around a valuer to go through the property, which is what we do, but it's overlaying data which is available from the, you know, the ONS or land registry or company's house onto that valuation to make sure we've really got it right. And actually then to be able to assess our book on an ongoing basis. So, you know, yeah, we got it right now. Where's the market moving, and sort of how is that affecting our loan book?
Do you use things like Zoopla or any of those like information services?
Yeah, we're starting to.
Okay.
Yeah.
I was checking them out the other day, you know, and it's pretty comprehensive stuff.
Yeah.
I mean, they'll rate a neighborhood based on average square footage, and they'll put a price on it, and things that weren't even available 2-3 years ago.
And pretty sophisticated demographics about the sort of people in there, so you can match that up with the sort of the developer that comes along and says, I'm going to buy this flat and this is what my end buyer is going to look like. You can sort of match that up. Does that fit the demographics of the sort of area that they're developing in, and that sort of stuff. And
your loan to value ratios are pretty high and skewed, so that protects you as long as you're happy with the asset?
Yeah, exactly.
What are the ratios, or just for people that don't even know the business very much?
So we won't lend higher than 75% of the value of the property. So every borrower's got to have 25% cash to put into the deal.
Right.
And historically, again, because we're not chasing borrowers of last resort, it's sort of, historically, it's sort of 60 to 65% loan to value.
Okay.
So it's sort of, it's probably guys that could do a couple of deals cash, but actually with a bit of bridging, a bit of sort of leverage, they can do, you know, maybe twice as many transactions as what they do in a year.
Okay, so that's why they come to you, because you give them a little bit of extra leverage that they couldn't get in a bull market. It's a no-brainer for you.
Yeah, and then
if this turns, do you start requiring more cash?
Potentially, yeah. I mean, I guess we're always sort of looking at the macroeconomic sort of situation in the market, and we take that into consideration. I mean, I guess we started lending in late 2008, which in hindsight was a good experience, but at the time, you know, wasn't the best time to be starting a mortgage lending business. But
probably the worst time.
Yeah, ever.
Or in, you know, but some people say that's when great companies thrive, is during these
and that's the point, I guess, is that actually in these downward markets or in a really depressed market, that's actually when people really need funding. You know, so actually you can get a better margin, and actually you can probably get better credit quality borrowers, because you know, in that time the banks had just shut down. Right. You know, you couldn't get a mortgage, so
they just stopped answering the phone.
Yeah.
Well, you guys started off. You started as a finance company, and now you're kind of a tech play. You know, a lot of people we have in here started with tech plays. They're looking for the next 20 mil, the 30 mil, the Series Bs. They're going to the States. They're ramping up. Are you guys doing the same thing, or are you a little bit more cautious in your expansion?
No, I think we're trying to be relatively aggressive. We've been sort of doing the VC rounds and going through that process. I guess we're fortunate in that our business is profitable, so we can sort of be self-sufficient and grow. Actually, you know, we can get to where we need to be, we think, self-funded. So that's a good position to be in. I guess it's a bit of a land grab at the moment. You know, everyone's sort of trying to be the biggest and the best platform, and you know, and accelerating their sort of development of their technology. So I think that's really what we'd be quite keen to raise money for. But but we're not cautious with our expansion plans. But at the same time, we don't want to take over the world. I mean, really for us, the UK mortgage market's, you know, 200 billion a year. It's a big enough market just to sort of, if we can scratch the surface of that, then that's going to be a phenomenally successful business, so we don't have to go and sort of go into other jurisdictions and that sort of stuff.
And stick to the short-term stuff.
Well, the broader vision is to be a mainstream mortgage lending business.
Okay.
And just peer-to-peer is just it's really an online lending business. That's the way we see it. You know, the process of getting a mortgage is so frustrating, it's so time-consuming. If we can use technology to make it a really cool and good, easy experience, then that will be a winner. So the fact that we're funded by peer-to-peer is just sort of, that's offering that as an investment asset class for investors.
Yeah, if you could globalize credit, you know, for foreigners like me to buy a place when you land here.
Yeah.
Because again, I'm not high risk, and I shouldn't be here. And if you can fix that problem,
exactly. That's a huge market. Just there.
Market, right?
Yeah, massively overlooked, and it doesn't make any sense.
No, it's stupid that you can't transport my credit history in Canada. And over here. Yeah. Who's easier? Where's the hiccup in your business? Is it hard to find borrowers, lenders, or are both of them pretty easy to find?
Well, it's interesting. Going back, when we set up the business, we were always capital short. So we saw way more borrowers than we had funding. And that was why we sort of actually set up the peer-to-peer business, because we looked at some of the other peer-to-peer players and certainly saw what was going on in the US. And obviously, there's a huge swathe of savers out there that are getting nothing for their money in the bank. So we sort of thought if we could set up or essentially wrap what we do in an online platform for investors to invest in, then it would be hugely popular. And actually it has become hugely popular, but not only for the peers, but also institutions are now coming to us, you know, and they're really keen. So banks are looking, you know, we're talking with banks actively for them to lend through our platform. Sure. You know, so because it's cheaper for them to actually use our technology to deploy capital for them. So I think as time goes on, it's really trying to broaden our borrower base as opposed to our capital base. But it's a fine balance, so it's a marketplace model.
Well, will banks actually use you? Because, you know, typically a lot of banks just want to use their own in-house systems, and they don't want to deal with other companies when it comes to lending.
You'd be surprised.
Really?
Yeah.
Because you're showing them the rates and
the yield we can achieve, and also what we're doing in terms of our credit underwriting. They're sort of saying, well, and it's not necessarily UK banks. There's sort of where we've found a lot of traction is perhaps a small European bank. And they say, yeah, we'd love some exposure to the UK mortgage market, but we don't want to have to go and employ 20 people to set up a mortgage desk and try and originate deal flow and learn that market. We can just go onto your platform and get exposure to it. And that's quite attractive.
Right. So NatWest and Abbey National won't be banging your door down. Well, I mean, I think probably out of pride alone, they never would do that, right? I mean,
well, you see, like Funding Circle's just done a deal with Santander.
Okay.
So I think you will start to see those sort of UK high street banks get involved.
Can you transfer your model to Germany, to France, to Italy?
Regulation's the big issue.
Okay.
Really. Yeah. So Europe generally is quite a regulated market, so it does become quite difficult. Yeah.
Yeah, I mean, it's something, we've had a few companies like yours, I guess Market Invoice and DoDeal, that it's basically, it's all about company's house, you know, for a lot of that info. And without that relationship, then it's not like you can transfer that business model to another country easily.
Damien was saying going to the US is tough because you got the States.
Well,
right?
it's the same.
And, right. So it's, you know.
And in the U.S., there's people kind of doing what you're doing, kind of. Although, you know, Lending Club isn't a bridge financing.
No, but there are some bridge finance operators doing it. So yeah, but actually, with those businesses, from what we can see, the large value for them is actually going through the regulatory hurdles of getting licensed in, you know, all the states and all that sort of stuff. So as opposed to necessarily the tech, but. Yeah.
You still lending money? You were doing some P2P lending, right?
Yeah, I did. I did some Funding Circle stuff just to sort of test it out. I thought it was really cool. I thought, so you guys minimum 10,000 investment.
It is £10,000 at the moment. We're going to reduce it.
Right.
Yeah.
And you know, how long do I have to have it invested before I can pull it out? Are there any limitations?
Well, it matches the underlying loan. Okay. So there's sort of 6-month loans. So that's sort of the period you'd have it locked up for.
So there's no secondary market?
Not yet. Okay. Yeah. So we're building that.
Right.
Yeah. We're just trying to get the tech right, as opposed to sort of open the floodgates and have, you know, 100,000 investors that get disappointed. We'd rather sort of keep it small, get it right, and then lower the minimum.
Yeah, that's what I put some in, and then I tried it out, and then I tried the secondary market, and
it didn't work.
Yeah, it wasn't great. It
wasn't really? Great. It's pretty liquid. How long ago was that?
Maybe it was about 6 months ago now.
Yeah. You couldn't get out for a decent spread.
I couldn't get out for really much of any spread, to be honest.
I got out at a premium on some of the loans recently. Yeah, but
maybe I'm just not so smart.
And who's impressing you right now in fintech when it comes to London? Do you even see other companies where you were like, oh, we'd love to grab them or partner with them? Or I don't know. What do you see in the space?
Yeah, I mean, I think companies like Funding Circle, I think they're an awesome business. You know, they're backed by the best VC operators out there. The management team are really switched on and sort of going for it. And some of the other peer-to-peer players, I think Zopa, you know, is a long-standing fintech business. They've sort of got things right. Yeah, other than that, we sort of just focus on what we're doing really and sort of just plug away at it. But I mean, there's tons of good businesses here. I mean, you know, TransferWise, you know, Doodle, all those companies. Even Wonga, you know, I mean, I think they're a phenomenal business.
Yeah,
at the end of the day.
I think they're a great business. I mean,
yeah.
I think they get the, what do you call it, the Daily Mail heats, or, you know, this kind of, what do they call it, a headline porn kind of stuff where everyone's like, don't do this, don't do that. But before that, I think it's a great business. I think it fills a great need. But I don't know, could they have done anything differently? I mean, okay, they recently paid some fines for what? Charging people, for
fake law firms.
Fake law firms to hunt them down. Okay, shouldn't have done that.
Yeah, exactly. That's hard to justify.
That was the employees,
well,
okay. But I mean, could they have done anything different, you know, with what
not really.
You're always going into a sensitive area, right?
They're always going to get heat. I think actually what they've done is they've gone into other jurisdictions. So they're sort of, you know, they're in various places around Europe now and sort of plugging on with what they do. I think, you know, they might be perceived to be coming under a lot of heat, but I think it probably will continue to be a hugely successful business.
Sure.
You know, they're as much as we don't like to talk about it, they're probably servicing an area of the market where there's demand there. There's people that do want quick cash to buy a pair of sneakers or, you know, whatever it is they do.
Well, payday loans have been happening forever. I think the real issue isn't Wonga, it's education. Do you know, I really think there should be basic financial monthly budgeting and education in early days in people's lives.
Yeah, I think it's a market that's been there since the beginning of time. It's just not that's been talked about, and it's been pawn shops in America, and I know next to a lot of, you know, Army and Navy bases, the payday loans are huge, and like, people just haven't quantified, you know, the interest rates, and maybe this is just puts it all in the open, and we can say, yeah, Wonga's having a hard time, but like, you know, like Christian's saying, they're just making mad money on the back. So,
It's interesting. We met with one of the VCs that were early investors in Wonga, and a guy from, you know, big investment banking background and all the rest of it, and he said it's really disappointing, our investment in Wonga, because for as long as I live, I'm never going to invest in a business as good as that again. So it's sort of, you know, it's hugely profitable.
Yeah. What do you see from the Yanks? Do you ever go out to Silicon Valley or at Silicon Alley in New York? I mean, you know, maybe you can't move your business model there, but do you see things that they do better than we do here?
Yeah, we go out there. So we're in Silicon Valley a couple of months ago. There's a big conference out there called Lend It for the peer-to-peer space. And it's about 1,000 attendees. It was a great event. But in terms of what we see out there, we're talking more to the investors. So, you know, the VCs and perhaps the institutions that are looking to deploy capital onto our platform. Right. And I think we see that they're more open-minded in many respects and actually probably a little bit more aggressive. Where what we find, the mentality seems to be a little bit in the UK is that sort of finding an excuse not to invest. Perhaps where in the US it's sort of how big's the market, how do we attack it, how quickly can we penetrate, you know, X% of it. So it's quite refreshing to go out to the US actually.
And would VCs use your platform to invest their money, or would you be talking to institutions and insurance companies and things like that?
Yeah, it's institutions to deploy debt.
Right, to deploy debt, right, okay. So less VCs, but just...
But the VCs for equity for our business.
Okay, right, okay, to get involved in your business, right, for equity plays. And what do you think about the P2P equity plays here in the UK and in the US?
I think it's interesting. So I think platforms like Cedars are really good. You know, I think, you know, Jeff Lynn, I think, you know, they've got a good management team there. They're sort of getting good traction. They're getting great PR, and I think that's really good, and that's really positive for the sector. I think, you know, as long as people appreciate when they invest on those platforms that there's a high chance that they will lose their money. And I think I've actually even heard Jeff say that at a conference, you know, the majority of startups will fail, and so the majority of investments you invest perhaps on a platform through, you know, the crowdfunding sort of model, then they will fail. So as long as investors understand that, then that's okay. I think the danger is that, you know, type of guys that are investing, you know, 100 quid here and there perhaps don't understand that. And that's the big difference between crowdfunding and peer-to-peer. You know, peer-to-peer is debt, you're lending, so there is a real expectation you'll get that money back, and that should be the case. But equity crowdfunding, yeah, I mean, there's a few players that are getting that right.
your risk profile is significantly less than an equity profile.
I mean, we're secured against property as well. So actually we think we're, you know, even of all the offerings out there, we're sort of as low as it goes in terms of the risk profile.
Have you had any flat out losses?
No, we haven't. So in 6 years of lending, we've never lost a penny of capital.
Have you had to liquidate properties?
Yeah, we have.
Okay.
And which is, you know, it's not a good experience, but it is in terms of experience for the business.
Right.
Certainly our first year of lending was the worst. And that's probably our real concern with the industry as a whole in terms of, you know, there's a lot of sort of tech startups getting involved in lending. And particularly if they're lending sort of to 3 or 5 years in terms of duration, it's a fairly slow feedback loop. You know, it might take them sort of 4 or 5 years to realize how bad they are at doing it, and they're doing it with other people's money. So that's a real risk for the sector. Where for us, we've been lending for a long time, short-term mortgages, 6 months. We're sort of, you know, we've evolved our model considerably in terms of our underwriting processes, you know, over 6 years.
When you liquidate, does everyone's money kind of freeze until that whole liquidation process is paid and everyone's paid?
Yeah, so we're only buy-to-let mortgages. So we never lend against a property where the borrower is going to live in there. So in our current model, so the law is quite pro-lender in that perspective.
It helps you get them out of the property.
It does, yeah.
Okay.
We can appoint a receiver, and the process is pretty swift. I mean, we can get repaid in a couple of months.
Okay.
Yeah.
And I guess there's no kind of securitization of your mortgages, so no one gets paid off first. It's just everyone loses kind of the same percentage of whatever you guys get hit.
Although on the platform, we've started tranching some loans.
Okay.
So we'll do an A tranche, which is sort of like up to 50% LTV, and then from 50 to 75, you know, you can be a tranche B. So you would sit, you know, second in the repayment profile.
Sure.
But yeah, I mean, we do every loan with the expectation that we're going to get it all back. So.
Yeah. I guess it's interesting how your cycle is much quicker. So you talk about like Cedars and some of these crowdfunding. You know, you may not realize for 6-7 years before you start to see real data on how successful people actually are. Yeah. And it'll be I'm interested to see the data.
Yeah, it will be interesting. Yeah. And it'll be pretty transparent as well.
Sure.
You know, you can get all that data now. So
yeah, it's going to be interesting to watch and just see, you know, if that goes where we think it's going to go, you know, and if a lot of these places really get, you know, the 200-300% growth that we're kind of expecting, you know. Yeah. Do you hire tech guys or finance guys?
Both. Yeah, so we've recently hired like a data scientist. So we're sort of big on that credit modeling and building tech into that side of things. But yeah, finance guys. I mean, with mortgages, there's still a human element to it. So there's a lot of, you know, we have human underwriters. It's never going to be a fully automated process. So they're finance guys, and then tech guys. Yeah, I mean, that's why we're keen to do shows like yours to sort of get exposure in the tech scene and really, because it's hard to get tech talent in London. Surprisingly, you know, it's really competitive. Okay. Yeah, it is. Yeah, and often perhaps they don't want to work for a finance business. You know, it's not perceived as being necessarily that trendy, but I think that will change definitely. So yeah, it's a full spread. We're hiring.
You have to sell them on the upside and where you're going and the scalability. Because
yeah, a little bit. Yeah, got to sell them on the dream, and particularly, you know, if they've got an experience of going for a mortgage, which often people do, and then they're just like flabbergasted at how bad it is, and then sort of you show them what we're trying to do, and then it doesn't take long for them to sort of get on board.
Are mortgages and the property market like the last bastion of illiquid markets in the world, would you say? Of the ones that are constantly exploited?
Yeah, potentially.
I mean, are they?
Yeah, I mean, I don't know if it's the last one, but it's definitely one that is ripe for disruption.
Right. I mean, for an asset class, it's so big. It's something everyone has to be involved in, buying, selling, lending. The bid offers are ridiculous. The amount of information used to be shocking. Dealing with Foxton's agents, yes, I said it, is shocking. I can't even get a phone call back. In the property bull market, they won't even call you back. Yeah. Like, I want to buy property, we don't even call you back. Yeah. It's
crazy. And so I bank with HSBC.
Right.
I have accounts in Canada.
I feel sorry for you.
I know. I have accounts in Canada and I have accounts in the UK. And I can't get a mortgage.
Is this you again about your mortgage again?
Oh, jeez.
The broken record.
Well, you put down 65%. It's like, oh, sure. Let me just go into my, my yacht.
The stories we hear are surreal. I mean, you know, if you go into your bank, you've been banking with HSBC for 10 years. Yeah. You go in and apply for a mortgage. The first question they're going to ask you is, what's your address and what's your date of birth? Right. It's like, dude.
Yeah.
How do you not know that? I mean,
so when
and you've got to sit there and fill it out on a form. I mean, how ridiculous is that?
When do they change? You know,
we're changing it now.
No,
it's when TransferWise is and these guys
when you
make
force
them
to change.
Yeah, exactly. Yeah, and that's why the government's behind peer-to-peer and fintech and all that stuff, because I think they've got to the point where they can't make the banks lend anymore, so they just create an environment that's hugely competitive.
Right.
You know, so groups like us come along and actually the banks say, shit, we do have to, I don't know if we can swear here, but, you know, we just have to get our act together. We don't have to, you know, now you've got to go through a 3-hour interview in the branch to get a mortgage.
Right.
Serious?
Do they still have huge margins in like the banks and the big building societies here and the mortgage businesses? Is that still big? Is that their prime moneymaker still?
I think it's a big money maker. Right. I mean, it's obviously heavily subsidised by cheap money from the Bank of England, which is why we're focused on the buy-to-let investment mortgage market at the moment, because it's where there is typically a much greater spread. So for investors, it's an attractive proposition as well.
Okay. Can you explain that as opposed to someone who's buying to, was it buying to live or buying to just hold the property? Can you just explain that nuance?
Yeah, so the easiest way probably to explain is if someone lives in the property, then it's a home loan. If they don't live in the property, then it's a buy-to-let investment mortgage. So we only lend where they don't live in the property. So it's property landlords, they're typically buying flats, buying and flipping, you know. They're property entrepreneurs in that sense.
Speculators in that sense.
Yeah, speculators. Yeah, exactly.
Entrepreneur.
Yeah, entrepreneur is better.
It sounds way better.
I love seeing tech grab all these markets like we see TransferWise.
Love
I mean, you know, I was talking with my bank the other day and had a similar experience where it was like, why don't you fill out your address? And you're like, are you just joking? I was trying to transfer money from my dollar account to my sterling account, and it was like, and I kept saying to the guy in the branch, have you heard of TransferWise? And the guy was like, oh, I think I heard of them. I'm like, I could do it on my phone. And he's like, I have to fax.
But cheaper.
He said fax. I need to fax this over. And I was like, and he was a young kid. And I was like, homie, did you hear what you just said? Fax. This is 2014.
It's crazy.
There's an app here where I can do it. And he was like, I know, but he's like, this is the way it is.
Yeah. They're institutionalized.
Yeah. And the credit stuff, I mean, you said, is there credit analysis really, are they big gaps in it? Is it?
I mean, I don't think it's particularly poor in the mortgage space. I don't think we're sort of building an argument on that. I think we can definitely say we do more, and by doing that, then actually it should get better. And we're trying to use big data and all those sorts of solutions to increasingly get better. So the defaults over time should get less. Not to say that the banks don't do that, but it's for us, it's more about making that experience better. At the end of the day, it's providing a mortgage online that's makes sense and it's easy.
What are the goals for you guys? Like next 12 months, next 24 months? What are you trying to do?
Just be doing what we're doing bigger and better, I guess. So we will lower the minimum investment amount to £1,000. So that will sort of broaden our buzz and PR appeal, I guess, and so hopefully sort of build the brand. But then continue to do what we do. We're sort of going to slowly go out the duration. So we're sort of trying to lend more 3-year product than a 6-month product. And then sort of get more investors onto the platform, do some deals with some institutions, get them on there, which sort of shows confidence to the market in terms of what we're doing, and continue to build out the tech. So the tech's actually the hard part as opposed to sort of getting investors and money. But
when are you going to let foreigners on to get me a 20-year
20-year
buy to live?
Yeah, hopefully in sort of next 2 to 3 years we'll be doing that. Yeah, it's sort of a mainstream home loan product.
Right. Yeah. As opposed to just the buy to let, like a home loan product.
And that would really open up. Is that
it's a huge market? Yeah. I mean, it's 200 billion a year is the UK mortgage market. The buy to let market's about 30 billion. Okay. So we think we're attacking still a pretty big market, but the tech's the same. It's just changing how we do it.
Right.
And do you really need those small investors of like the £1,000 each, or do you really need the institutions to come on board and the tech to be better in your mind?
We don't need either, but I think it works better with both. So interesting, like with Lending Club, it is largely institutions now. So they almost go full circle. They start as sort of community lending platforms, and then the institutions take over. I think for us, it's quite important to have the crowd. Property particularly as well, it's got sort of a social element to it. There's a lot of people that are perhaps left off the property ladder. They can't get on, but they can invest in a mortgage in that area. So perhaps that's a way for them to get exposure to the asset class that perhaps they couldn't have got before. And that's interesting. I think that sort of is a useful part of the investment process. So I think it's individuals through to institutions.
I would guess that the chances of someone using the service lending is probably more likely to use it as a borrower too, right? Feel more familiar with the platform and just understand it from A to B.
Which actually is like the Lending Club story. Is actually, if you look, underneath the bonnet, it's really important to have a crowd there, because people feel, well, actually, I might take a mortgage from them. It's a slightly more expensive product, but actually, I'm borrowing off the crowd. It's a really simple, easy process online. I'll take a mortgage with them. So you sort of get brand loyalty through that.
I'm just visualizing the day when, like, young kids with bank balances will be going on with their apps and choosing, I can get a 0.5% if I do Bank England, or I could get and throw, 20% of my portfolio over to these guys and get this return. And then it's like all there with the ratios and charts. I mean, why not, right? As opposed to everybody having like the same risk profile as a borrower and as a lender.
Well, I mean, you put your money in the bank on deposit, what do they do with it? They go and lend it out, and they lend it out with leverage, and put it into the mortgage market predominantly.
Right.
So
sometimes enough to crush the bank. Yeah. We won't even get to Northern Rock. What was Northern Rock doing with your money that you couldn't have been doing, right?
Yeah.
What about the property market? I mean, like, how can I describe the property market as like it's an ego-crushing experience, no matter where you are in the socioeconomic spectrum. I'm sure Abramovich, when he's like one Hyde Park, and he's like, 140 million, I can't afford that. I could get 2 players for that. Yeah, but I mean, he's in pain, and then like your average person's in pain. Everybody trying to buy property in this market. It's how do you live in London in this property market? Or how do you exist? I mean, it's it's a macro question.
It's a property obsessed nation. I think it goes back to same in the US, same in Australia where I'm from. You were sort of told from a young age that your goal in life is to own the family home. Right. Because people feel wealthy and they feel a sense of well-being or sense of security by doing that. So that's everyone's aspirational goal.
Is that misguided, do you think? Do you think property ownership shouldn't be something?
I think it is a little bit, actually. Yeah. I mean, I think the population generally is slightly more transient, or probably a lot more transient than what it used to be. If you own a property, that's a serious investment, perhaps one that you can't afford or shouldn't necessarily be committing to. Right. And it's one that's, like you say, it's hugely illiquid. So aspiring to that is maybe not the most sensible thing, but for a lot of people it is. I mean, it depends on your circumstances.
Yeah, we saw the extreme of that in the US, basically, in 07, 08, where everybody was over leveraged, and we hear everyone that cried afterwards, but then you had all these people that were just taking these huge loans out on these huge houses that they had no business buying, but it was part of the American dream, and it was kind of sold, and I think it always will be that way.
Yeah, I don't think that's going to change anytime soon.
No, I think you're right. I think sometimes people are. I was never a property buyer, which is why I'm poor now. But I used to always tell people, they're like, "Oh, I'm buying a house," and I'm like, "You're not buying a house. You're buying 85% of a house, and the rest, you are getting a loan on, and you're paying interest on that." And people are like, "No, I own my own house." And I'm like, I guess that's a finance guy's way of looking at it, right?
Yeah, definitely.
Yeah. I own back home, but here I haven't. But to be honest, I think my rent that I pay now is probably less than I would pay to carry a mortgage.
In the UK?
In the UK, yeah.
Really?
Because, my landlord, she bought my place in like the early 90s.
Yeah.
So she hasn't really sort of revalued it or lent against
They're
it.
They're laughing all the way to the bank.
Yeah, right they don't really care. So they're like, have a reliable tenant, long-term tenant.
Yeah. You should get a mortgage.
There we go.
Yeah. Oh, man. Again. All right. Christian, we ask everyone here a few questions at the end. I'm going to hit you with them. If you could make a phone call to the 20-year-old Christian Faes and give that young man a bit of advice, what would you tell him to do? To go into tech early? To not? What were you doing at 20?
I was studying law, which I think is actually a good sort of grounding for doing anything thereafter.
Jeff Lynne is a lawyer?
Yeah, exactly.
You guys stick together?
Yeah. Probably just do what I was doing, to be honest. But in reality, get into tech earlier. Yeah, I think, or study tech, actually. I think learning to program is something that I probably should have done.
Can you do any coding now? Can you look at the code?
Well, when I was younger, I could do like HTML and that sort of stuff, but very basic.
You should learn.
Very basic.
Maybe you should learn. It might actually help you in your business.
Yeah, I got a lot of spare time.
Code club.
exactly.
A lot of spare time. On that same note, what's best advice you've ever received, business or personal?
There's no substitute for hard work.
Spoken like a true American. Wow. Who told you that?
My parents.
Really? Okay.
Australian parents.
And what did your parents do out of curiosity?
They were entrepreneurs as well.
Okay.
Yeah.
Okay. I think that's great. Yeah, hard work.
Yeah.
It's no free lunch, no shortcuts.
No shortcut, yeah.
Yeah, it's funny because we've had some people on here that say, we have one guy that said he leaves by example, as in he's not the guy that makes everyone work till 8 o'clock at night. He's not that entrepreneur. But we've had plenty of other people that's sat there, like Davinia Nolas from Moshi Monsters, that said, you got to be obsessed with this startup.
Yeah, definitely.
You have to be in the shower thinking about your startup.
Yeah, it's a 24/7 job. I mean, but it's not a job in the sense of going and slaving away at a desk. I mean, it's a lifestyle, really.
Are your former colleagues jealous of you?
Yeah, I'd imagine they possibly are. So some people are cut out to be a lawyer, to sit there and do documents all
Billable
day.
hours.
Yeah, exactly. Account for every 6 minutes. Some people like that.
Not you. Last part of that question is to 20-year-olds that are listening around the world, what would you suggest that they do if they want to get, kind of involved in the tech business? I mean, you came around a roundabout way to this.
Yeah.
What would you say?
I mean, I think with everything in life, just don't overplan it too much. Just do it. You can sit there and sort of have the perfect plan about what you can do next year and the year after and all that sort of stuff, but just go and do it. And if it's a startup, you don't have to have the most. A lot of people say this is not the right way, but you don't have to have the most perfect business plan because it's always going to change anyway. I mean, you should have an idea of where your financials are going to go and all the rest of it, but there's no better way than just getting out there and doing it.
Yeah, everyone in tech is learning on the job. Like they all are, even if they're pretending like they're not. Yeah. So I think you could even argue that everyone in the world is learning on the job. But a lot of people are like, I don't know anything about tech. I don't know who to call. And I agree. Maybe you should just jump in.
Yeah, and it's always changing tech. From what I understand with the tech guys, the languages are changing all the time. The methodologies, the thinking behind it all it's constantly changing. So again, you can't sort of spend 10 years studying it and not doing it. You just go out there and do it.
Yeah, it's not like your classic industries like law or banking where having that 10 years and that firm, like everything's constantly changing, acquisitions, that kind of thing. So, did I miss anything?
No, I think that's good, man. I guess, are you guys hiring? Are you looking for borrowers, lenders, everything, all of the above?
Looking for everything. I mean, I guess if anyone's interested, have a look at the site, lendinvest.com. If anyone has got tech expertise, please come and have a chat with us. We're definitely hiring, looking for the best tech talent in the city, really.
Should they look in their portfolio in their bank and they're like, okay, I would never think about doing this, but should they think, well, maybe I should take 5% of my portfolio and put it in a property-based asset, maybe take advantage of the bull market without putting equity down and get an extra few percent on your money? I mean, I guess you're trying to educate investors that way, right?
Definitely. I mean, of course I can't provide financial advice, but...
And neither can we. Did I just do that?
But, for me, it makes sense. And that's sort of that was really where we came to this initially in terms of, as an investor, where would we put our money? And we were looking at the other offerings and thinking, it's just not really good enough. So, lending secured against property, decent return, it's a good proposition. Yeah. It's one that people should look at.
One thing is if you're in the middle of this housing boom and you want to, quote unquote, get in on it, it's basically impossible unless you want to be a speculator yourself or you want to go find that property and go in all the due deal, which nobody wants to do. But this is a kind of a great way of getting a slightly lower risk profile, but still getting some pretty nice returns on your money, getting exposure to this market, which I don't think is going anywhere personally. So,
what's the average return for a lender?
The average at the moment is 8%. And actually, a lot of our investors that are coming onto the platform now are sort of buy-to-let landlords, funnily enough. They're sick of dealing with the tenant that's not paying them, the plumbing issues, all the sort of issues that go with holding a property. Saying, well, I can take 8% per annum. I'll go and do that.
So they passive, online.
Right. Because if they went to you to borrow, they'd have to make like 25% per annum just to make their 8,
more
right?
Of a stretch.
That's funny, man. I never even thought about that. Interesting. And if people want to get in touch with you, what's the best way if they're looking?
Email. I'm on Twitter, Christian Faes.
Okay. And your website for LendInvest. And excellent. I love it. I just like seeing these kind of nuanced tech and credit tech kind of plays here going on.
I hate the banks.
So you really brought out a bad side.
I know, it's a bad day for it too.
Easy theme.
Did your motorcycle get stolen again? Or what?
No. I've been trying. I've been trying to move an investment account back home in Canada through HSBC, and it's taken me a year. Next week.
Dude, we're just still not done. We're just bad-mouthing everyone today. HSBC, Wonga, we got lots of enemies. So well, it's real, at least, right?
I'm grumpy today.
Okay, good. Well, hopefully, Christian, you and other people can get this whole kind of credit issue and this global credit piece solved, because it's like this glaring, from a finance guy, like property and mortgages are this glaring aspect where I just think everyone gets taken for a ride, and it slows down GDP, having this big inefficiency here. And I don't think it does anyone any favors. And when that one day we get these liquid markets, maybe even gets to where we can invest in REITs or something like that for you guys, where you can really put your money in any asset class you want. Everyone's gonna be better for it. So I'm a big fan. Fantastic, love this stuff. Episode 54, we got picked up for our 3rd season on YouTube.
Apparently,
it's good news.
They still allow us to upload the videos.
Yeah, they love it. Audience is growing. The guests are getting better and better every week. So feedback's been fantastic. Yeah, I know, right?
We've peaked.
I'm joking.
Yeah, it's fantastic. We've got some great people working for us. If you want to get involved in the party, send us an email at hello@siliconreal.com. If you're listening on iTunes, come see our extremely good-looking faces on YouTube, and it's great. I love finding out about the people. That's our slogan. It's about the people. Christian, all the best.
Thank you,
and lots of luck to you guys.
Yeah, thanks for having us.
Thanks, man.
All right, guys, take care.
Cool.
Data isn't as valuable as information, and to create information from data, you have to create context. We opened this up, and that led to the revelations of Starbucks and Google not paying tax. It was huge. Understanding who owns a company and and who that is very, very important. This was something that could really change the world. Data is not the new oil.